When it comes to analyzing the housing market, a lot of people tune into the national news to understand what's happening. But as the old adage goes, real estate is all about location, location, location. And that's true with housing trends as well. So let's dive into what's happening in the Triangle region of North Carolina as of the end of March 2025. Of course, this is just going to be a blip in time, but if you're a buyer considering a move to the region, I've got a bunch of great news for you. But before we dive in, my name is Matt Martin, and I'm a Raleigh-based realtor. I've helped tons of clients, just like you, relocate to the Triangle region of North Carolina, and if you're looking to do the same, I'd love to help you too. Now, I can't tell you how many times I talk to potential new clients who express concern that the housing market is about to crash, or that they're going to end up in a bidding war with 50 other people and have to pay tens of thousands over ask, or that there just isn't any inventory, so why even bother looking? And a lot of these concerns are being fueled by national headlines, but the Triangle region of North Carolina is its own market that even has its own smaller micro markets within it. And our trends don't necessarily follow the national averages. So let's start with probably the biggest concern I hear, and that's that prices have increased too much, too quickly, and the market is now crashing. So why not just wait to buy? I want to break that down. First, is the market in and around Raleigh crashing? Well, let's take a look at the year-over-year numbers. And for this video, I'm going to focus on single-family homes in 5 of the major counties that make up the Triangle: Wake, Durham, Orange, Chatham, and Johnston. Right there at the very top, you can see that the median home price hasn't crashed at all over the last year. In March 2024, we were at $494,000 versus $490,000 this year, so a teeny tiny drop. So no, the market isn't crashing. But is that a sign that it's slowing down? Maybe, but I'll talk about that in a little bit. Now, if you look closer at that graph, you may see that there were periods over the last year where prices did come down. So let's talk about that. Really, it comes down to seasonality. I made a whole video all about the best time to buy in the Triangle, which you can find here. And my research showed that prices can swing as much as 8 to 10% within a year, typically reaching their lowest points in the wintertime and peaking around June. The lowest point typically is February, with March seeing an average rebound in pricing of about 3 to 5%, which is exactly what we saw again this March. So if history repeats itself, we should continue to see price increases over the next few months. But prices are a function of 2 things: supply and demand. So let's dive into those. We'll talk about supply a little later, but first, let's check in on buyer demand. Now, buyer demand is measured by 2 things: number of closed sales and number of pending sales. And this is where things get really interesting. Closed sales are down 4.6% year over year, but pending sales are at their highest March level since before interest rates started to creep up back in 2022. So what's that telling me? Well, closed data is a delayed metric, as it's based on contracts that were signed likely 1 to 2 months prior. So most of the deals that closed in March went into contract in January or February. And what was happening in January and February 2025? People were still sitting on the sidelines as a new president, old president, was inaugurated. And election years always throw the market for a loop. And my theory is that this one was no different. So buyers just took a little more time than usual in January and February. But pending sales tell us that buyers are jumping back in the market. March 2025 saw about 2,100 pending sales, which was 3.5% higher than last year. So when I hesitated earlier about if the drop in sales prices meant the market was slowing down, this is why. I think the start of 2025 just lagged a little more than usual, but more recent numbers are painting a picture of demand picking back up. And when demand picks up, that typically means prices do too, unless you have enough supply to meet that demand. So let's talk about that supply, which is measured by active inventory and new listings. In other words, what's sitting on the market and what's coming to market. And here, we have really good news for buyers, as it seems sellers have finally started to list their homes. Active inventory is up 33.6% year over year, while new inventory is up 19.2%. And it's not just a March blip. Q1 2025 saw the highest level of new inventory, 6,500 homes in total, since 2021. So far this year, we've seen nearly 600 more homes listed than at the same point in 2024, and almost 1,000 homes more than in 2023. Now, this makes sense. Interest rates started to skyrocket in 2022, so homeowners that were sitting on 2 and 3% rates just refused to give those up. But as more time has passed, life has happened, people have had to move, financial situations have changed, and I think sellers are accepting the reality that if they want to move, they're gonna have to come to terms with losing that amazing rate. I also think this huge bump in inventory in March also explains the big jump in pending sales. More inventory means more options for buyers, which animated a big chunk of the buying pool that had become frustrated with limited choices. Now, back to how this all impacts pricing. Buyers seem to start off 2025 with a bit of hesitation, but if March's numbers are any indication of what's to come, I think we're gonna have a lot more activity to help gobble up all that new inventory hitting the market. But the big question is, will it be enough? So far in Q1, our pending sales to new listings ratio has averaged 77%, which means we have 23% more new listings each month than contracts signed. You have to go all the way back to 2017 to find numbers like that. And if that rate continues, supply is going to outpace demand and prices will likely soften. But March's pending sales jumped more than average this year. So if that trend continues and buyers continue to come out of the winter slumber to take advantage of the higher inventory levels, we may see prices follow their more seasonal trends. Whew. So, if we have more inventory and slower activity by buyers, this inevitably leads to questions about competition. And we have two ways to measure competition: days on market and the list price versus sold price ratio. If competition is high, then properties won't last long on the market and they'll likely sell at or above list price. And if competition is low, the inverse will happen. So it probably won't surprise you, based on what I've said so far, that average days on market is slightly up versus last year, from 14 days to 20. Now again, I want to caution about reading too much into this, since I've already said that buyers were slower on the uptake this year than in the past. So it makes sense that properties sat a little longer in the first quarter than last year. But that's still a whopping 43% increase, which means that on average, buyers have more time to make a decision about their purchase, and the chances of bidding wars and stiff competition have come down. Then we're seeing the same thing reflected in the list versus sale price ratio, which now sits at 99.3% versus 100% last year. That means that a year ago, an average house listed for $500,000 was pretty much selling for $500,000. But today, it would go for about $3,500 less. Again, these aren't huge numbers, but they are showing that competition is slowing down and the average person is not paying over ask for a home. Now, of course, if we revisit location, the perfect home in the perfect location in perfect condition that's priced perfectly, well, that's still going to be competitive. And I've got a lot of strategies for how to win in those situations. Now, those are just the region's averages, but as I keep saying, real estate is hyper-local, so based on the city or area you're interested in, the numbers may look significantly different. For example, homes in Holly Springs only spend an average of 10 days on the market, while Clayton sits at 32. Homes in Chapel Hill are selling over list price in an average of 11 days. So make sure you're working with a real estate professional who understands the nuances of the myriad of communities across the triangle and how they may play into your ultimate chances of getting that house of your dreams. So it doesn't seem like the market has crashed or is on course to crash. Buyer demand has softened, inventory has increased, competition is down, days on market are up, and the average home sells for less than asking. That's all great news, right? Yes, But as I mentioned earlier, we're just coming off of an inauguration that caused a very slow start to 2025. I think the next 3 months are going to give a much better idea of where the market is truly going and how strong demand actually is. A lot will also depend on what happens with interest rates, especially as the bond market continues to fluctuate. But with 70 plus people moving to the Triangle every day, I do know that we'll continue to have a steady stream of new buyers. But will there be enough to eat up all that new inventory coming to market? Time will tell. So that's your market update for March 2025. What stood out to you the most? Let me know in the comments below. And if you're ready to take advantage of reduced competition and want to kick off your house hunt in the Raleigh area of North Carolina, I'd love to be your guide. You can reach me by phone, email, or text, and you can find all my contact information in the link below or by scanning this QR code right here with your phone. And if you liked this video, I have a whole catalog of others all about moving to, living in, and buying real estate in and around Raleigh, North Carolina. Here's another one here that you may like, so give it a click to keep on watching.